Welcome back, investors. The Ticker Time News. I'm Adam, and follow-through selling sent the stock market sliding at the open before the S&P 500 flirted with Friday's low, 38.37, seen here on the chart, highlighted in blue. Our gap down on Friday, right here. Friday's low in the morning. Our gap down this morning, and our low this morning, almost identical. Except the highs for the day, today we got a little bit higher. We got to that 3,900 level and could not break above it. So that is still resistance at the moment. Now, the S&P 500 today, it did find support there at Friday's low, which was today's low, around that 38.37 level. The main indices dance around most of the morning and most of the afternoon, right around that break-even line before finally jumping ahead to catch a bid in the final hour of trading and then accelerate to the 3,900 line or level. The S&P 500 or SPX was up 0.7%, 38.99. So just shy 1 point from that 3,900 level. The SPY was up 0.7. Actually, you call it 0.8 if you want to round it up. 388, again, 390 for the SPY is a crucial level. The Qs were up 0.6. They closed at 291. 290 is a critical level for the Qs, so that was encouraging. And then the IWM was up 0.9%. It closed at 180, and 180 is its line in the sand. So SPY, Qs, IWM, two of the three are right at their line in the sand, and the Qs are 1 point above that line in the sand for resistance. And I mean stiff resistance. Now, the bid in the final hour of trading today, that was helped along primarily by mega cap stocks finally catching a bid themselves and rallying into the close. Now, the S&P 500 broke out of a very narrow trading range, very narrow, but found resistance again, like I said, at that 3,900 level, closing a hair shy of that important psychological number. All right, let's clean this chart up here. I went with the blue highlighter today instead of the green, because that green I thought just blended in with the candles too much. What do you think? Is the blue any better? Okay, there was some hesitation in play ahead of the September 20 through 21 FOMC meeting and subsequent rate hike decision. That meeting takes place this week on Wednesday, September 21st. We will get our decision on rate hikes. 50 basis points, 75, 100. I believe it's going to be a 75 basis point. And the probability of it being a 75 is also the highest. So the market is basically saying that, yep, it's going to be a 75 basis point rate hike when Fed Chair Powell first gives the press release at 2 p.m. on the 21st, and then 30 minutes later comes out and talks. Now, that press release, it'll have the rate hike number in it. Look for 75 basis points. The wild card this week is what Fed Chair Powell may say. Will he simply back up what he said at Jackson Hole, or will he add something to it? That's the important thing. Plus, we do get the dot plot this time around. We haven't gotten an updated dot plot since June. It's released every quarter. So we're now at a new quarter. We get the dot plot. That will set monetary policy for the rest of this year. For the fourth quarter of this year, it will set that policy, the monetary policy. Now, the dot plot is going to show us where FOMC members think the interest rate hike, or where the interest rate will be at the end of this year. 4% or above is what I'm saying. I don't know how much above. It's very likely, excuse me, it's very likely that we could get a 75 basis point rate hike with our September meeting on the 21st. We could get a 50 in November, a 50 in December. That's still aggressive, and that would still take us over the 4% mark. But are we going to get another 75 basis point rate hike in November, in December? That would be very aggressive. And the market has not priced in that. Not at all. The market has barely priced in a 50 basis point rate hike in November. I think the market has got it tuned in right now for the 75 basis point rate hike tomorrow. I mean, not tomorrow. Later this week on the 21st. But it does not have tuned in or priced in what Fed Chair Powell, man, I'm just messing my words up left and right. What Fed Chair Powell could add to what he said at Jackson Hole. Remember, he was very hawkish, very blunt, very short in his comments at Jackson Hole, and that got the market all in a tailspin. And if we remember, I'll go back to the daily view here for the SPX, S&P 500. We can remember that was a big drop off in the market that day. This candle right down here, and let's keep this color blue for now until you guys tell me otherwise. That red candle underneath that blue line, that was Jackson Hole. SPX, S&P 500, it dropped 3.3%. Okay. All right. In addition, this morning, what helped this afternoon to get this market into positive territory was Treasury yields. Treasury yields were a focal point that pressured stocks early this morning. However, stocks did rebound as Treasury yields begin to pull back from their morning highs. Now, the 2-year yield, let's do the yields real quick. US is 0 to Y. Remember, you can do this at home. There's a link in the description to TradingView. Click on it. It doesn't cost you a penny to sign up and use it. Now, if you want more advanced features in your charting, then yes, they do have a tier-based pricing structure. But you can chart for free. All your basics are there. Everything you need. This is the 2-year. It has been on a very aggressive run. Okay? The 2-year today, the yield reached 3.97%, nearly breaking 4%. Its highest level since 2007. Since 2007. That seems like an awfully long time ago. Got chopped up today? Yeah, today, tomorrow, it's going to be rough. And then, of course, Tuesday morning will probably be a flat trading session. And then Tuesday afternoon, watch out. There'll be some wild swings. Okay, highest level for the 2-year since 2007. Now, it did pull back in the afternoon, which helped stocks to gain a little bit of momentum into the close. But again, getting up to that 3,900 on SPX, 390 on the SPY, 290 on the Qs, 180 on the IWM, the red line in the sand for all of those indices. The 2-year coming back down helped. Now, the 2-year did settle at 3.49%. What is the 2-year sensitive to? Everyone should know this by now, right? The 2-year is sensitive to the Fed funds rate. Okay? So when the Fed hike rates, the 2-year will go up. When the Fed is cutting rates, the 2-year will go down, right? Okay, it is sensitive to the Fed funds rate. Now, the 2-year settled at 3.94%, right? It's sitting there right now. Now, the 10-year US 10Y, excuse me, the 10-year has been on a march of its own. The 10-year reached 3.51% today, its highest level since 2011. That's over a decade ago. This level, 3.51%. It's been over a decade since the 10-year has been this high. And what is the 10-year sensitive to? The 10-year is sensitive to growth concerns and inflation. We've got inflation that is holding strong. And depending on what happens to our economy, there are several scenarios in which inflation could actually tick back up again. That wouldn't be good. Not one bit. But yeah, it's been on this trend line, the 10-year. This started on August the 2nd. So for 2.5 months now, it's been running along this trend line. It's been using its 5-day EMA as its support base. Whenever it gets really above it, if it has a big day, you can count on the next day being red and pulling right back down to its 5-day EMA. Okay, it's 5-day moving average. Now, the major advantages, they squeezed out decent gains by the close. But market breadth still painted a very mixed picture. Decliners outpaced advancers, so stocks going down, there were more of them by a 4-3 margin at the NASDAQ. While advancers led decliners, stocks going up beat out stocks going down by about a 3-2 margin at the New York Stock Exchange. I find that interesting, right? Since the Qs, QQQ as the ticker, technology, growth, is 1 point above its red line in the sand where it closed. 291 is where it closed at. And it's holding there in the after hours. It's up about 0.2% in the after hours. So here's what I think is going to happen tomorrow with the SPY, the Qs, the IWM. I think tomorrow on the Qs, the 5-day EMA is declining, right? And it is just a hair, probably about 293. Let's see, is that right? Yep, 293 is where the 5-day EMA is. I could see a green day at least up until that moving average, and then it might cool off from there, right? The reason on Friday I thought today would be a green day, and that turned out to be true. Wasn't so sure that this morning. But the reason it turned out to be a green day is simply the market was starting to get oversold. It wasn't overextended to the point that it is oversold, but it had been racing down and gapping down at that. So I expected a small bounce. I don't think this bounce is going anywhere unless the Fed, unless Jerome Powell is more dovish in his speak, which I don't see that happening, then the market would rally. So I could see tomorrow being green also. I mean, if we look at the RSI here, it's at a 36. So that's 6 points from being oversold. This can go on up. This can go on up a little bit. At least take the RSI to the 50-point level, which isn't that far of it's not that big of a gain, but give it a little more relative strength, right? That could happen because it's not oversold, but it's getting back down there again. And same thing when it happened to the SPY here. Oh, and I do have the updated weekly expected moves for the SPY, Qs, IWM, SPX on the chart. So they are updated here. Everything else, I don't update until at least Wednesday to give our investor community time to have those weekly expected moves. Now, one thing I'll point out here about these weekly expected moves, I think the options market got tired of losing, got tired of being beat by price action, and they set their weekly expected move this week with a larger range, a bigger range. So they set bigger risk, basically a bigger spread between the upper expected move up here and the lower expected move down here. That's what I noticed the options market did for this week. So I definitely expect the options market to get it right. I do. Although Powell could really spook the market, maybe, and things could just collapse. But that's why it's never 100% win rate. But yeah, I talked to our investors about that, about the options market being off, and just a couple thoughts on that. I posted that already. But yeah, that's something that I noticed this week with the weekly expected moves. So the bottom end of the weekly expected move for the SPY is 373. The upper end is 397. Still underneath that 400 level. I mean, that's just something. Okay, big gap down left from Thursday to Friday, partially filled today with today's candle for the SPY, but the same thing. It's RSI 36, so it's 6 points above being oversold, and its 5-day EMA is at 391, and it closed at 388. So, and let's just go to the IWM. So tomorrow could be a green day. That's all I'm saying with this that I'm pointing out here. RSI is at a 40, so this one's 10 points above being oversold. RSI, I'm sorry, 5-day EMA is at 181. It closed at 180. So not that far off. This one's moved up better. And then last one is SPX. And again, just like the SPY, RSI is at a 36. So it is 6 points from being oversold. The 5-day EMA is at 39.19 and it closed at 38.99. So I could see a green day up to that 5-day EMA, and then anything above that would just be a bonus from what I would expect to see. Because since reaching this top back here on September 12th, this candle right here, the market has just been on a downtrend like that, and it's been moving very quickly, very rapidly down. All right, let's get to your questions real quick, and then I'll talk about the sectors. Since we are close to the top of the expected move for the Q and SPY, are you planning to add an inverse position? I am thinking of waiting until tomorrow and see if the rally continues. I like the blue highlighter, FYI. Oh, good. Using that green highlighter, it just, once I said, you know what, I use blue trend line so I can see the trend line better. Why don't I just use a blue highlighter? That's probably better than green. Okay, good. I'll continue using blue. Okay, all right, so here's the play that I'm doing this week, okay? I am not trading on the 21st, on Wednesday. I will not be trading on Wednesday unless the market shows a clear and precise path in its direction. All right? Because if Powell comes out, we get the 75 basis point rate hike, and if we get basically a copy and paste from Jackson Hole or even his speech from last week, then he's not adding anything new. Okay. And if he's not adding anything new, then there's nothing new for the market to fear. That's what could get this market rallying. Now, on the flip side of that, if Jerome Powell comes out and adds something a little more hawkish, a little more bold, a little more aggressive, that'll send the market down. So it's all going to be on what Jerome Powell says. I mean, word for word, what he says on Wednesday. And then whichever direction the market decides that it wants to go, and again, it has to be a clear and precise direction. Because if you look at past rate hike decisions, just go back last month. I mean, the market, as soon as the press release comes out, it'll spike one way. And then once Jerome Powell starts talking, it'll spike back down in the opposite direction. I mean, the market will move quick and very sloppy in between the press release, which comes out at 2 p.m. Eastern, and when Jerome Powell starts talking, which is about 2:30 p.m. Eastern. He can add something that the market takes as more hawkish, the market's surprised about, and then it can go in the opposite direction. So no trading on Wednesday morning for me until the market has a firm direction that it wants to go in, or if I hear something myself that to me will confirm, okay, he's being more hawkish than what I even expected him to be, then I know the market's going to drop and I'll hop in then. So that's my play for Wednesday. Tomorrow, I think the market could creep up just a little bit. It's not going to be a huge rally. It could potentially be something like today, 0.5% to nearly 1%. I guess that's possible, but I don't think it'll be much. Okay. Now, we do get a couple of reports out tomorrow that are for the housing market, building starts and permits. They're not big catalysts or big movers for the market, but they are for the housing market sector of like the S&P 500. So if there's something real surprising there and the housing market starts to tick down, well, depending on how strong of a move it is, I mean, that could potentially affect the S&P 500, the SPY, not so much the Qs or IWM, but it could. So tomorrow, yeah, I might do a couple of, short-term long positions. I have nothing opened right now. I didn't want to go into tomorrow with anything open. So I may open something tomorrow if the market, if it does something like today where it drops early on no real news except for the Treasury yields popping. And then once they start cooling off, then that gives you an entry point. Or just not do anything tomorrow. Wait for the big moves that come later this week. Now, inverse, I love playing the inverse ETFs as well. So if I think the Qs are going to go up tomorrow, or if they, start moving and it looks good, moving in the up direction, TQQQ. On Wednesday, if Jerome Powell is extra hawkish, if he surprises us with a full basis point increase and the market's going down, SQQQ. That's to play it on the short side, and those are leveraged ETFs as well. So that's possible. Over the past few weeks, I've been playing long and short on the Qs more so than the SPX, because the Qs have been moving with bigger percentage swings. So obviously you can win a little bit more by doing it that way, since it's been playing out that way. But if you look at it today, I mean, the SPY outperformed the Qs relative to each other. So, but you do have SPXS if you want to go short, which is the inverse for the SPX. And then you have SPXL if you think it's going to go up. And again, you can see here, for me, it's when I'm using these leveraged or inverse ETFs or ETNs, direction, those are the ones that I like to use, okay? And if I go down here, nope. I thought TradingView might have the link there. But direction ETFs or ETNs, or what they technically are, I love their products. And those are the ones that I try to use. Sometimes, I use others, as you guys know. But this is SPXS. This is inverse. It's leveraged. So when the market goes down, this goes up. As you can see here, as the market has been going down since August 16, this has been trending up. So just measuring that real quick from the 17th, just a rough estimate to today, and of course today was a loss. That's a 32.15% gain since August 17th. So for about a month, it says 33 days. So a month, 32% in 1 month. That's not bad. And this is an inverse ETF to the S&P 500, the SPX ticker. Okay, so it's SPX right here. SPXS. There we go. A little delay there, right there. SPXS is the ticker. All right, let's clean this up a little bit. Let's see here. Honestly, I don't want new data. Can add just a hawkish tone, maybe. Yeah, I don't think there will be any. I guess data is the wrong word, right? When I use the word data, I was thinking more of a data point that I can use. Jerome's Powell speech, there's no data with his speech, right? But I guess in my thinking, Jerome Powell's speech and what he says is a data point to me. So I shouldn't have used that word. Good call there on that one. I do want Jerome Powell to be honest. Okay. So if Jerome Powell thinks, well, we're going to have to be very aggressive. Inflation is becoming structural, meaning it's hanging around far too long. That would obviously be something that would cause the market to reset its valuation, go down, basically, right? In this market, just look at 2022 for the S&P 500. You really cannot be, and I heard this and I can't remember where I heard this from. You can't be perma bullish or perma bearish. You have to be perma flexible. And if you look at 2022 so far, yes, the overall trend is down. The 200-day moving average, it has rolled over and it is going down. But there have been lots of little rallies and bounces all along the way, including the, I think, overshot summer rally that we had. And if you look at where we are now, I mean, we're really going back to June and July time frame as far as valuations for the market right now. And June, July, this highlighted portion right here, it's where we came off the June low and then just started to pinball around before finally making a decision about the summer rally, right? So we're basically back here pinballing around, kind of just waiting for somebody to tell market participants, it's okay, it's not getting better. Let's go and retest those June lows. Now, everybody here knows, unless it's your first time watching, and hello, thank you for joining us today. I greatly appreciate it. That I do have this yellow box down here, all the way down here. Now, this box is where I think the market could go by the midterms, which would be, let's just call it November 1st, to keep it simple. This is down here around 3280, okay? Around 3280 down here. So for the market to, find its way down here, that's a really big drop. And to undercut the June low would have to be about right here is where that June low would be. So it's a pretty good big drop to get down there. And if we go find, well, where were we in history to reach this? Oh, come on, that's not what I clicked on. To reach this point, well, we're going back to 2019 highs. That's really where this number comes to. Plus, it also matches up with once we, V-shaped bounce with the market. Once we got back up to September, October timeframe, and we had that double bounce right here, this double bottom through October and then November of 2020, that's also where this is lining up with this number here, this 3280, okay? So it's a 2019 high, and then the 2020 fall, October and November double bottom there. That's where I think we could go by November 1st. Midterms. Once we get into October, midterm stuff is going to be crazy and uncertain. And yeah, there might be some red wave coming, who knows really what to expect. But markets don't like anything uncertain. Markets don't like surprises. So when that does occur, the uncertainty from the election, well, that's going to throw this market into another gear, and I think pushing it lower. Plus, valuations are high. And FedEx from last week, when FedEx moved lower, because it came out and said, hey, you know what? Earnings are going to suck. We don't know what's going to happen for the rest of this year. The entire globe is slowing down, not just the US, but the entire world. The entire world economy is slowing. And remember, FedEx ships packages. When you order something online, FedEx is moving that package. So FedEx knows when the economy as a whole is shrinking because FedEx moves less packages. So they're a bellwether to what is happening to our economy. Dow theory. Transportations and industrials. Industrials build it, transportation ships it. So if the industrials aren't building it, there's nothing for transports to ship. FedEx is saying that's what's happening right now. That means a slower economy is to come. It means we're in a slowing economy. So we got that. All right. Let's see here. I don't want to miss these questions. What do you think about, and then we throw it up here on the screen. What do you think about a strangle? I feel like premiums are still too high. Premiums are high. This market right now, historically, that back half of September, which we are in, and the front part of October, that is one of the more difficult times throughout the year to trade. Historically, the market's volatile. The market can drop. The market can rally. The market can just be almost like 2022, irrational. There's no sense to what's going on. And that's what makes trading this environment awfully hard. Because sometimes it's too hard to call. Now, we can use technical analysis to say, hey, you know what? These sectors, there's a relative strength here. Okay, maybe we can, find something positive here. But as far as this week, with it being historically a tough time to talk, a tough time to trade, and Jerome Powell talking, and he could say literally anything. I think the risk right now, at least until Wednesday, I think the risk is a little bit too high. And that's why I don't have anything open right now. I do not plan to have anything open tomorrow or Wednesday, although I do have a plan to what I need to see in order to open a position. I hope that makes sense. So me personally, I just think that the risk right now is a little skewed out of my favor. So I'm just going to be patient. I'm going to be patient until Wednesday afternoon. And then I have a plan. I know what I want to do. I know what I need to see or need to hear, whether I'm reading it or listening, which I'll probably be listening to Jerome Powell, because it's critical. And getting the dot plot, that's something that we'll get from the Fed because it comes out every quarter. Last time was June when we got it. And we'll understand where the Fed as a group is thinking the interest rate should be by the end of this year. I'm thinking 4% or higher, which means we got to see 75 now, 50 in November, 50 in December. That'll get us to the 4% and over. So I'm saying right now it would be a little too risky for me. Obviously, you got to make that call for yourself. I'm waiting until Wednesday. Maybe I'll do a quick trade tomorrow if the market has some momentum behind it. I think it can be a green day, not a huge one. It could match today. But today also had a big drop in the morning and then it climbed out of it. So I could possibly take a short, long position for just tomorrow, just one day. And I won't have anything open going into Wednesday morning. And then I'm waiting for Powell. So I have a plan in place. I won't have trades open until I feel confident that risk has flipped and now it's back on my side. Okay, that was a long way to say I'm not. I'm sorry, I'm 7 minutes behind. Looks like I calculated the moves differently than you. My top ends are a bit lower. Oh, the weekly expected moves. Yeah, no worries. Let me just run through those right quick. SPX, the top end is 39.90. The bottom end is 37.56. Now, again, like I said at the beginning, what I noticed this week, the options market gave a bigger spread between the top and bottom of the weekly expected move. And like I said at the beginning of this live stream, I think the options market did that because it's tired of missing it, right? All right, so for the SPY, the upper end is 397. The lower end is 373. Let's go on to the Qs, and then we'll move on to the sectors. Let that load here for just a quick second. All right, the upper end for the Qs is 300. The lower end is 278. And then I'll throw the IWM up here. This is your small caps. Let that load right quick. All right, the upper end of the weekly expected move for IWM, and that's the ticker, 185. The lower end of the weekly expected move is 172. All right. So every week, those numbers come out Sunday evening for our investor community. And that's where the options market, based on a whole formula and calculation, where the options market thinks the market will be by end of business of Friday. By the end of business on Friday. Okay, let's keep moving on. Let's go to the sectors here. There were only two sectors. Only two sectors that closed with losses today. Let me lower this just a little bit. I'm going to get the dollar back in there because we got to look at the dollar, and I'll look at semis too. Okay, healthcare was one of the two sectors that was in the red. Healthcare here, it lost, looks like a percentage point. And we also have real estate as a loser, and it lost, it looks like about a percentage point as well. Now, the gainers were led by materials, which is XLB, up 1.6%. And then we had consumer discretionary, XLY, up about 1.2%. Now, In our trade setups that went out this morning, we mentioned healthcare, XLV, and let me just pull that up right quick and go to the 15-minute chart. And the reason we mentioned healthcare is because we saw relative strength in healthcare. And if we open healthcare up, you can see that over the past several sessions, there's been 2 big gap downs for healthcare. Okay. So it had been, let's open this up even further. Let's get closer, get into today. Today we had that drop down first thing, 9:30 a.m. and this thing was hitting a low of 124. It closed at 126. This is the 15-minute time frame, so that you can see once hitting that bottom this morning, first thing this morning, by 10 a.m. right there, 30 minutes after the open, it had hit the bottom and it started trending up. And then it accelerated into the close. Another sector that we mentioned for relative strength, and this is on the 15-minute time frame, the RSI is at a 70 when it closed today. Your different time frames will show you different numbers, so just keep that in mind. That's why I said on the 15-minute time frame, it's at a 70 right now. Looking at the daily time frame, just right quick, you can see that today, this candle, if this doesn't look like a reversal candle, I'm not sure what it is. I mean, this is nearly textbook reversal candle looking here, where, and then we get the highlighter again, the candle itself, and the RSI is a 44 right now. You've got the body of the candle, it's right here. It's not quite as wide as the marker there, but then the wick of the candle goes all the way down like this, and there's no wick at the top. That's typically a reversal candle. So look at the reversal right here. You've got the body of the candle, okay? And then the majority of the wick is right here on top. And it just has a little tiny wick on the bottom of it, like that. So that was a reversal candle. That signaled that it had reached the top and we're coming back down. Well, same thing now down here. It looks like a reversal candle. We've hit the bottom and now we're bouncing back up. So keep healthcare on your radar. This could be positive. All right. Retail was the other sector that we mentioned, and I just want to pull retail up here. Getting back to, yes, absolutely. I can answer that. And I may actually have a chart. I have to check right quick to see if I have a chart that demonstrates this. Or I could possibly just Google it. Real quick, just retail XR. Oh, I'm going to get my cursor back. XRT. Retail was another sector, really a subsector, that we thought had relative strength this morning. And I'm going to go into the 15-minute chart here for retail. Retail doesn't have a hammer candle, but it did have a doji candle on Friday, okay? And when we go into the 15-minute time frame, you can see retail had a pretty big bang this morning. So it opened at 61.61. The high was 62.62. That's funny. For the day, it popped this morning from being down, obviously, and then just moved sideways and then rallied into the close like most everything else. So real good rebound from this morning's low. Again, not big moves. There wasn't a lot of big moves this morning. But those were two that we thought had relative strength today. And just wanted to call those out. Now, the third one that we called out this morning was solar. Okay. Solar had good, TAN is the ticker symbol, TAN. Solar has had good relative strength. So we called solar out this morning as well. Now, solar, it had a quick start out of the hole, but then solar drifted lower throughout the day. And then just as you can see here, this is the back end for our Patreon. 8 hours ago, trade setups, I'm not pulling anyone's leg here. And I know you guys watching know that. Right here, second paragraph, most notably today is solar, ETF, TAN, healthcare, XLV, and retail, XRT. In a market that appears to be on shaky ground, these groups should be sought for stability until proven otherwise. So solar, healthcare, and retail because of the retail report that came out, the most recent one. Those three sectors, or subsectors, I should say, except for healthcare, those three groups, they have good relative strength until proven otherwise. All right. So we put those out there this morning. Also talked, and I didn't think to mention this one, ticker symbol XOP, which is the oil and gas exploration and production. It hit a breakdown for us, and energy has been a tough sector. When you're looking at oil, it's been bobbing up and down, and I have that crude oil and gasoline prices have been on the decline, but natural gas has been on the rise. And natural gas being on the rise is what's been able to hold or prop up the energy sector, XLE as the ticker. So if buyers do not defend this breakdown and rebuild with a reversal soon, gasoline, crude oil could be in for further downside. So I didn't plan to mention that, but I thought it would. All right, to your question here, and I'm going to answer it. And while I'm answering it, I want to see if I have a picture to demonstrate. So historically, we are in midterm elections. We are in a president's first term, second year, midterm elections. And historically, from now until the election, so November, and this is also why my we'll come right back to the sectors. I don't want to leave your question hanging. This is partially also in my thesis for why I think the market's going to go lower until election day. Historically, the market will go down from now until election day. Real simple. From now until election day, the markets will go down. Historically, in this exact moment. I thought I had it, but I guess I don't have a picture of it. Let me see here. Give me a quick second. I am I'm almost there. I know that here it is. Here it is. And it's from Almanac Trader. All right. It's loading. Give it a quick second. This is the perfect This is perfect. All right, there it is right there. Let's open this up. Here we go. All right. So this image right here is showing you what you want to look at is the red line, okay? The red line is the second year new Democrat president, being very specific, okay? S&P 500 midterm election year seasonal pattern since 1946. The red line is your Democrat president, second year in office, midterm election. Red line is what we want to look at. And once you get to September 1st, you typically have a rally you typically have a rally right here, right? It pulls back and goes back up. So then once you get to the middle of September, you then fall. Then you have a rally in early October, and then a quick drop off into the election. So from the middle of September, about where we are right now, until election day, it is in a downtrend. Okay? And then once the election occurs, that's when you have a rally, but it'll pull back again, but you make a higher low this time from your bottom, and then December, Santa Claus rally into the new year. That's seasonally what it looks like on the midterm election, the seasonal pattern going back to 1946, a Democratic president in their second term, which is exactly where we are. So from now until election day, the market is in a downtrend and it makes a lower low. And I guess something else to point out here about that low that it makes right before, that low right here is a lower low than the June low. Interesting, huh? That lower low is a new low from June. So in October, and it's exactly where I've got on my chart, making that new low. Maybe it might not go that low, but a lower low from June. I guess that's something else important to point out. And, you know, if you notice here, the peak was maybe the third week in August. And if we go here and look where the summer rally peaked, August 16th is when it peaked. Not quite the third week of August, but pretty darn close. And since then, the market's been trending down. And the market from now until election day, historically, will continue to trend down. So a historical reference there that helps to support my thesis that the market will go lower. We haven't seen the bottom yet. And I'm just trying to pull this up a little bit. So the June low is just over here. Seasonality says we break that, and that would be about right here. And when we break that from the middle of August high to the November 1st bottom, you know, maybe the line's going to end up looking something like that. But the Fed's going to have to be more hawkish. We're going to have to get some more weak data to help push the markets that low. I mean, valuations to me are still expensive. A market that's down, I mean, what's the S&P down right now? 18% year to date. I mean, is that really that much? Is that really that much of a drop? 18%. So for all-time high, for valuations, all-time high in history. Is an 18% pullback really that much? Now, I know some mega cap stocks are down 30, 40, 50%. Some small caps, 60, 70, 80%. Yeah, that could be enough. But we'll have to see. Okay, so that answers your question there about the midterm elections. When was the last time Fed rate hike and elections happened? Oh, I do not know that one off the top of my head. I can tell you this. The Fed has never increased rates as fast as it has this year in recent memory. Maybe one time before, maybe in the 80s, Paul Volcker, maybe he raised rates as quickly, but from the time rates started to go up to right now, to the rate hike that's going to happen on Wednesday, it's either the fastest rates have gone up in history or it's the second fastest. I would have to double check what Paul Volcker did in the 80s to see if he raised them quicker. But rates are going up extremely fast. Another point, the Fed has not in my memory, the Fed has not raised rates into a slowing economy before. That's why many economists believe, and I believe this too, that the Fed is going to raise rates until something breaks. Whether that's something in the economy, whether that's something in the bond market, the Fed is going to break something. That's how aggressive they're going to be with raising rates. That something will snap, will break, will cause pain to people and businesses. Just like Jerome Powell said at Jackson Hole, you will feel pain. And businesses will feel pain too. FedEx is like one of the only, I know there's more, but I can't think of them off the top of my head, one of the only big companies to come out and give a stern warning like Jerome Powell gave a stern warning at Jackson Hole. Other companies will be following FedEx lead here. That's the pain Jerome Powell is talking about. So I will look up this question here to see if the Fed has raised rates into an election. And let's see here. Okay. So right off the bat, so this is going to take a little more than just a Google search. I'm going to have to do some research to answer this question, because right off the bat, it's conflicting information. One says the Fed does change rates in an election year, and then one talks about presidential elections, and the Fed won't hike rates before a presidential election. So this is going to take a little bit of digging, a little bit of research to find your answer. I'll find an answer, and I'll talk about it on the live stream tomorrow. So I'm looking at an LA Times article. This is going back to when Alan Greenspan was the Fed chairman. And it looks like they have raised rates during a presidential election. But they've also struggled with it. Back when Alan Greenspan was Fed chair, let me show you this article right here real quick. It said, quote, "I wish we had the luxury to sit back and do nothing until after the election is in. I'm sorry. It just changed size there. Let's see here. I wish we had the luxury to sit back and do nothing until after the election, as is the conventional procedure of the Federal Open Market Committee. That's the FOMC. He said, which was Alan Greenspan, the Fed chairman. I don't think we have that luxury. Nevertheless, the committee voted not to change rates at that point in time. Every 4 years, the independent Fed faces the same predicament: how to try to manage the economy without appearing to favor either party's presidential candidate. Those concerns will be front and center this week as Fed policy meet to consider a small hike. Yeah, not small right now. Yeah, I don't want to leave you guys here bored while I'm just reading through this stuff. So I will research this topic, and I'll get back to you during tomorrow's live stream with an answer to that, because I do not know. I don't know that one. Okay, let's see. What else did I want to talk about? Oh my goodness, there were so many things. We've already been going an hour. I appreciate your questions. I love them. Absolutely do. The last place we left off were sectors. You're welcome. Absolutely. I will research that this evening, and I will report back during the live stream tomorrow on that question. But it looks like a quick answer is the Fed may have, but it also looks like the Fed wrestles with it when they have to, and they would prefer not to. They would prefer not to raise rates, at least during a presidential election. Midterm, the Fed, I don't know for sure, but it's not as, it wouldn't be as weighted. It wouldn't be as hard for the Fed to raise rates during a midterm, because a midterm, you have hundreds of elections across the country going on. So it doesn't matter as much versus a presidential election where, yes, you do have many races across the country, but you have one very important race across the entire country. So, okay, I'll get back to you on that one. Let's see here. Home builders also were a good sector today. The ticker symbol for home builders is XHB. I got to get my cursor back. XHB. They were up 1.8% today. This subsector here. And also the there's another construction-based ETF. I can't remember it right now, but it was also up today. And this came as participants awaited August housing starts and building permits. That comes out tomorrow at 8:30 a.m. Eastern. And that followed the NAHB housing market index that was released today. Now, the energy complex, and that report, I'll share about that in just a moment. It was below a 50, which means contraction. So the housing market is contracting. Spoiler alert. All right, then let's hop to energy. Energy complex futures, they were mixed again. Like I mentioned in that trade setup note about gasoline prices and oil being up and down, right? Well, if we look at oil, just type in US oil in TradingView, real easy ticker to remember. WTI crude oil futures, they fell 0.5% to $84.96 a barrel. But, and just like I said in the note right here, where, oil has been falling, but natural gas has been rising. Natural gas was up 0.1% today. So oil is holding flat. I mean, look at these last 3 sessions. Just absolutely flat with the main candle. Now, the body of the candle has been the same. The wicks, though, Friday's wick looked like it could be a reversal. And then oil moves up, and it's up now in the after hours. It's no longer under $85 a barrel. It's over $85 a barrel. Now, today's economic data, it was limited. Again, like I mentioned just a few moments ago, the NAHB Housing Market Index, which came in at a 46. Expectation was a 48. A number below 50 for this report indicates declining confidence in the housing market. The housing market is contracting. Okay, almost done. Actually, one more thing here. What's up for tomorrow? Looking ahead to Tuesday, market participants will receive the August housing starts. The expectation is 1.44 million units. Prior reading was 1.446 million units. So not a big change with expectations and last month. Let's see if it can beat it. Then we also get building permits. Now, building permits are forward-looking, okay? That means the house has not been built yet. Housing starts is reverse-looking, okay? So you're either looking in the past, which where housing starts, or you're looking in the future, which is building permits. Now, building permits, the expectation is 1.61 million permits. The prior reading was 1.674 million permits. So the expectation is down from last month. And that's unfortunately what you would expect to see in a housing market that's contracting. Now, again, both of those drop at 8:30 a.m. Eastern. Okay, if you have questions, plug them in now. I got to say again, I love your questions. It's the whole reason I do this live stream. We do this live stream every day the market is open. I've reached the end of my notes, so if you do have questions, now's a great time to ask them. And before you go, please do me a favor. Click the like button. Share this video with a friend. Those 2 things greatly help out this channel. And if it's your first time watching, consider clicking subscribe. And one last thing. If you like this perspective and you want to get our trade setups, our top 10 stocks lists for different categories like growth and value and dividends and momentum, numerous trade setups, weekly expected moves, experimental but daily expected moves. We sent out daily expected moves saying or showing that a bounce was likely today. The daily expected move that we sent out to our investor community specifically called for a bounce today. Risk was shrinking, reward was growing on a day-by-day basis. That a bounce today was likely, and we got that bounce today. Click the first link in the description if that's information that can help you along your investor journey. All right? Click that first link in the description, and you can get that information all for you. All right. Do you think, well, let me throw this up here on the screen. Oh, and if you want to join our Discord server, we have private and public channels. That's the second link in the description. Do you think Jerome reiterating his hawkish tone will spook the market? I don't think if Jerome Powell is just reiterating what he said at Jackson Hole, I don't think that's necessarily going to spook the market. What spooks the market, and I sent a note out to our investor community today talking about this exact question right here. The market moves up or down when the market gets surprised. And if Jerome Powell is only reiterating what he said at Jackson Hole, that's nothing new. That doesn't surprise the market. And when the market is just getting old information that it already knew, the market will shrug it off, not think much about it. It's when the market is surprised by something new and the degree of how surprised they were, like a 100 basis point rate hike would surprise the market. The bigger the surprise, the bigger the move. And of course, if it's a negative surprise, the market's going down. If it's a positive surprise, oh, we're doing a Fed pivot, then the market will go up. So, no, the market will not get spooked hearing the same information that it just got a month ago, not quite a month ago, 2 or 3 weeks ago, the 26th of August. So yeah. And it just as a matter of fact, it was this note sent right here 7 hours ago. Not too terribly long, but it was this note about rate expectations, and it talks specifically in there about what that exact word about the market being surprised or not. All right. Is that everything? Is that all everyone's questions got answered? I'll give a minute here just in case you have another question. I don't want to miss any, so I'll give you time to plug them in. Again, tomorrow for the main indices, I could see a green day tomorrow. I could see the SPY, the Qs, IWM, SPX. I could see them all moving higher, at least to their 5-day EMA. They need to reconnect with that 5-day EMA. And the market today, on Friday, I said that today would likely be green because the market had gotten a bit stretched. It was way off of its 5-day EMA, which is the most frequently tagged moving average out of all of them. And I get it. Yeah, it's only 5 days, so it should be the most frequently tagged. But it's real good for when the market or an individual stock, like right here on Friday, the 5-day EMA, I wonder how much I can blow this up so you guys can see. It's this blue line right here. So on Friday, the market closed here, which was way below that 5-day EMA. So the market moving back up in that direction today, getting closer to it, that's what it should do. The market should, it's probably going to flatten out a little bit more tomorrow because of today's rally, But tomorrow, it should move higher to at least reconnect with it. I don't know about going over it, but it should at the very least reconnect with it. And you can see in this downtrend right here, every day, even though, it closed off of it, these red candles coming down, intraday, it would go up and tag it before coming back down. And when it gets away from it, like here, it's not even connecting with it. Then it ran up right through it. It was a nice gap up. Ended up being a red day, but it did reconnect, right? So I could see reconnecting with it just like it did on this day right here. So that's a horrible arrow. All right. You answered all my questions. Thanks. You are very welcome. All right. Then I'll wrap this show up until tomorrow. After the market has closed, we'll come back. We'll talk about this, what happened in the market, why it happened, and what to expect. Even though I think we did a lot of what to expect today about the what the market, what the Fed might do, and how the market might react to it. So again, thank you all for being here. I greatly appreciate each and every one of you. If you haven't already, please do click that like button, share this video with a friend. Join our private investor community. We give out a ton of information that is very helpful along your investor journey. Just click the first link in the description and you can get all the information there. Okay, well, I'll wrap it up here. Thank you again, and I'll see you guys in the next video.